Just one day left before the month end. So as September comes to a close, it's not just the monthly closing, but it is also the quarterly closing levels for the market. And what will that tell us about the direction going forward? Now, it does give us a couple of clues about the larger trend that has developed since COVID 2020. Because when we close down for this quarter and we think about it from the Elliott wave angle, it gives us the completion of a certain structure. Now, what that structure is and what is the completion is a discussion for my next long short report. But broadly speaking, we have been in a bull market for the last several years. It's 5 years since COVID, and that bull market is not over. What we have ended up seeing is long periods of noise, consolidation, a lot of negative news, but a lot of it got absorbed in 2021-22, and a lot of it is still getting absorbed in 2024-25. It has not resulted in what we would call a significant sell-off, 15-20% decline in the main indices. It has led to certain corrections in individual sectors and stocks, and that is a fair thing to happen, especially when you're trying to clean out, the mess from what happens in a bull market. Is that a bull market lifts all boats, and then you come to know which boats really have holes in them, and they get sold off and sink. And then the bull market continues. But during this process, there will be more boats that will also get lifted. So let us not believe that there will be no more new speculative action in different stocks. Every time there is a run in the market, there is going to be speculative activity. But what these periods also allow you to do is to, remove and reset your portfolio to stocks that are actually performing. Where is the growth and where are the valuations worth paying for? I think that is the bigger question, something that we spent an entire day trying to answer using various data points, scanners, and tools in the Strike Analytics platform at Goa when we did our annual mentorship program just more than a week ago. So that was a full day exercise where we scanned stocks and tried to see which are the ones really fill the long-term fundamental narrative out of the stocks that are really performing. The market has already done its job of shaking out the weaker ones, but some of the weak ones where growth was there have rebounded from lower valuations as well. So it takes a lot of insight to go into each case and then come up with that judgment call. Yes, nothing is wrong over here. But it's very important because if you're not done and dusted, and there are always going to be many, many new ideas and opportunities in the market to benefit from. And that's sort of what has been the driver of this market so far. So when we say that this is a stock market, the question you should be asking, is this a market of stocks or a stock market which is an average of stocks? So therefore, are you looking at the index or are you looking at individual items? So many times we do get carried away by the near-term moves in the index and try to determine where it's headed, and that's part of our job. It's also something because a lot of us may be trading the Nifty, and therefore the next 300 points, 500 points actually matter to Nifty traders. But when it comes to the market as a whole, sometimes it matters less, and a lot of noise can come in between because these shorter-term moves can come along with a lot of news flow. Especially when the market sells off, you suddenly get some kind of negative news, whether it's the yen carry trade. This time it's been more of Trump's tariffs and his, attacks on different sectors. But some of them are more meaningful and some are less meaningful, and discounting that becomes the key. And therefore, during this period, what we've also seen is that many stocks have actually outperformed the Nifty as well. They've gone up irrespective of what the Nifty is doing. And that is why the question, is this a market of stocks? And if you're really focused on stocks, you can actually do much better. And it was very important to go through an exercise which helps you find stock ideas, whether they are short-term, medium-term positional trades, or whether they are your long-term investment ideas. Differentiating between the two and finding those opportunities is an important part, and we can do that with some very, very simple tools. The RMI scanner to the strike valuation setups, and a little bit of deep dive into individual stocks fundamentals if you're really looking long term. So that is a whole process that you need to get used to if you want to achieve those results. Now, while all this is happening, you also have a very extended US market, and it can get you bothered. I've read a lot of stuff which says that it is gone too far or it has become very overvalued. The funny thing is we've been reading and hearing such things for more than a decade, and therefore made it very, very hard to discount. when you really run it through the chaff of data, the research that I read about the US says that growth is still going to be there over the next, couple of quarters as far as the Y-on-Y GDP numbers are getting reported. So those numbers are not going to turn bad. Now, if those numbers are good, can we really justify these levels? So it comes down to really the technical setup. Now, technical setups can sometimes give you short-term, corrections, but will it lead to a medium to long-term reversal? And that is something I'm still trying to figure out as far as the US market is concerned. What I can see is, yes, there is a case for a short-term pullback, but I cannot be very, very certain of the medium term, some kind of a bigger sell-off. Will it happen, not happen? There are some indications it can. There are others that it has not yet started. And therefore, you can get caught between those narratives. I think we'll have to just watch it very, very closely. Some people will actually look at things like the dollar or the dollar index for clues as to whether we are hitting a risk off or a risk on. Unfortunately, either the yield curve or the dollar index has not gone far enough for us to believe that these moves are detrimental. Which would be that bond yields are falling, the dollar is rising, and you actually have a risk off event going on. You also don't have the yield curve going above 0.6, which would be a point at which you could say either that more risk is coming into the market or that the market has discounted everything. We've just been below that level for months and months together, and therefore not getting any signal from that data point. That leaves us with the dollar, which has continuously failed to get back above the 20-week average, even though when I look at the weekly charts, I do see a decline in volatility as far as the dollar is concerned. This decline can sometimes mean a rebound, but the rebounds keep failing. So we are still watching it closely. Will this current rebound that we have seen over the last week in the DXY actually manage to go through to a higher zone, or will it falter once again? Because if it falters once again, then we'll again see it lose, several points on the downside, and that will again stimulate the moves that we have been seeing in precious metals. But if this was a bigger dollar decline, and I have believed for a long time that it has just not moved on from gold and silver to the rest of the commodity market. Copper prices have been attempting to go up for a long time, but they've really not broken out of the previous consolidation range that they went into. And for other base metals, they've even not picked up. So this is the overall setup. I've very quickly given you various clues as to what we are seeing. I think the one data point you can still use against the Indian market is going to be the USD INR. That is the rupee itself. The rupee has been weakening, especially because of the impact of US tariffs. And if you look at that and you look at the potential harm that it does to the current account deficit, it is very, very hard to be bearish on the USD INR, which means you have to be bearish on the rupee. And this even in an environment where the dollar has been falling, the rupee has actually been falling even more and losing ground against the dollar. So unless we really get these trade talks with the US to a better place, the rupee will continue to weaken. And depending on how you view that, you might end up having a different view on markets. Now, sometimes we have witnessed in the last few years periods of time where the rupee has also weakened and the Nifty has also gone up. So I won't be surprised if that happens as well. But a weak rupee does create a macro risk that you don't want to really deal with, especially when it moves up rapidly. And I think that is still a hanging sword till we get these trade talks to the right place. So that is something that can continue to bother you in the near term or the medium term till India-US talks don't conclude, to something that we can say that, yeah, this is it and, nothing more is going to come out of it. Then we can actually deal with the problems that we have. But right now it's between hope and despair as to whether things will work out or not. Of course, there's a continuous narrative that, yeah, we will try to work something out. But US keeps, bouncing it back, saying that, they don't like the way that we operate. So that doesn't help in the overall negotiation, but let's hope that something comes out of it. So it's a matter of time. Eventually, we end up looking at the near-term technicals. Some of them are getting very, very oversold, which is why today, while I'm recording, you can see some kind of a bounce back in probably the Nifty futures, the GIFT Nifty futures. But will it sustain? Will it not? We are getting short-term very, very oversold. So definitely that gives you some hope that near-term, maybe a lot of the selling over the last 5-6 days is coming to a close. Maybe give it another day or two is what I will end up doing. Let the monthly expiry go behind. And then we'll take a call as to we have a near-term bottom. But will that near-term bottom be the final bottom for the year? I think that is the bigger question that I'm going to try and answer in the next couple of days. I don't have a 100% answer to it. It's just a a feeling or an anticipation that we've been through a long grind and therefore we should be there. But the 100% answer only comes when you actually see the momentum turn. What I can say is that because different stocks and sectors have bottomed out and started to outperform against the market, this is basically a rotational bottoming process where stocks and sectors that have not yet bottomed are still doing so right now as the market falls, and those which have done so are outperforming irrespective of what the market or the Nifty is doing. So this is the thing that we are really dealing with. If you're in the right places, you'll find that your portfolio is rising. If you're in the wrong places, you'll probably find that it's falling. But eventually, all the selling will be over and you'll get a much more broad-based rally in markets in the months ahead. And that is the moment that we are really waiting for, to see that the weaker segments of the market start participating on the upside again. In the meantime, if you have the right tools and the methodology, you should be able to pick the winners from the rest of the pack. And that is what the focus was of this year's Goa Meet. And I hope a lot of you can figure that out, get to use the scanning tools and relative strength analysis to find pockets of strength and opportunities to really profit from. So now, until next time, that's all from me. Thank you.